In October of 1963, I was a freshman at Ball State University, and I needed a B out of my economics class to stay in school because my other English and math classes were not very good. I had D's in them. And I got the B. And that pretty much set me on my career of learning about finance. And that actually brought me to where I am now with a YouTube channel sharing my knowledge. I'm a retired financial advisor, CFP, CHFC, CLU, got basically a doctor's degree in finance. And so I share my knowledge. I'm in a unique situation. I don't need the money I've accumulated. I'm not in a wealth preservation mode, even though I'll be 78 years old in a couple of weeks. I'm actually still enjoying the hunt. More than the kill. I enjoy getting the knowledge and learning and then sharing it and then using it to benefit my portfolio. So with that in mind, I knew I was different. Drew, who runs our Discord, suggested that I sit down with Mark, who is a bit younger than me, but in the wealth preservation mode, as he says, and basically get in a tit for tat or point counterpoint discussion about today's stock market. So about a week ago, we did that, and Drew basically edited it down. And so that's what I want to show you here. What we normally do is we share this with the people on our Discord. We don't make it public, but I'm so proud of what we do on the Discord and how we're helping people make good investment decisions. I wanted to share it with you so you got a better idea about what is a Discord. A Discord is basically a place where people form a community to come together to make better investment decisions. In addition to interviews like what you're going to see, I every Friday do a Zoom call with the members of the Discord, and we discuss the current markets. Right now, we're very deep into what I'm believing is the collapse of China and how we can make money on it. What's the ramifications of the Soviet Union, not the Soviet Union, showing my age, Russia invading Ukraine, and that's what we discuss and we talk about. We had a good discussion just the other day on Occidental Petroleum, and as it turns around, right after the discussion, I learned that Warren Buffett has made an application to own up to 50% of Occidental Petroleum. These are the kind of things. And where did I learn that? A member of my tribe from the people I talked to on Friday sent me the article on it. So I want you to see what we're doing, and I want you to experience Mark as well. So watch this.
Best of Us Investors presents Carrie Griegmeyer.
Hello, Carrie and Mark. Thank you very much for being a part of this discussion to share your experience and wisdom regarding the market, especially in a downtrend like the one we have today. And I'm sure a lot of people would find this meeting very helpful, having the chance to hear from someone who has been in the market for over 30 years and have went through a number of recessions such as the subprime, dot-com bubble, and also the major crash in 1987. So I do have a number of questions and would love to hear both your thoughts, since you two have a somewhat different approach in selecting stocks or investing in the stock market. So my first question would be, are you both worried about the market today, that it may go more lower and take a long time to recover? Or are you enjoying the market sell-off, since you both have been through these bear markets or crashes? And I wanted to see how you both feel and what your plans may be.
Yeah, worried is not a good word for me. I don't worry about it. As I say, I've been here before. I've experienced it. I'm confident of what the next move is. It will be up. I don't care to say exactly when, but we are you've got to recognize that we're in a period of change that we've never experienced anything like this before. I would ask if you're old enough to just roll the clock back to 2002, 20 years ago today, and we were in the same thing. And we were, if you'll remember, we were at the verge of the digital revolution. Well, now we're at the same place, but it's the verge of what I would call the digital 3.0 and the advent of artificial intelligence and machine learning. And all you've got to do is, get away from the talking heads of what's going on in today's market and see what artificial intelligence is actually going to bring us and what the metaverse is going to be like. And then I just don't see how you can worry about the unintended consequences of a coronavirus. What we're dealing with is the flood of $9 trillion into the market in 9 months. And that basically increased our money supply by 40%. Well, you have to have inflation. Then at the same time, you shut the world down and you have a lack of supply. Well, now you have a lot of money, which creates inflation, and very few goods, which creates a lack of supply, which again adds to the inflation. This is just, I'm sorry, this is poop in the toilet and you just got to flush it.
Carrie's right. A lot of money's gone into this market. Am I worried about, the market today? No, because both Carrie and I are too old to worry about things we can't control anyway. But, bear markets are normal. I went back and I just looked at some statistics and, since 1928, we've had 26 bear markets in the S&P index, and we've had 27 bull markets. So the average length of a bear market is about 289 days or 9-10 months. The average length of a bull market over that period of time was 991 days or about almost 3 years. So, on average, we have a bear market, every 3.6 years since 1928. And since 1945, we've had a bear market every 5.4 years. So they're getting further apart. So, I really can't be worried about, the market going up or down for me personally. Assuming that you've been investing for 50 years or you're going to invest for 50 years, based on the numbers, you're gonna go through about 14 bear markets in your investing life. So, get used to it and learn how to do it. You can go back in history and see how you can navigate around bear markets, and people can make money in bear markets just like bull markets.
Yeah, so thank you very much for sharing your insights. So another question would be, when do you think this downtrend will end? And are there any indications you keep an eye on, or do you just keep dollar cost averaging since you think the company you're invested in will be at a higher value in 10 years from now, and you're not even concerned about the price right now?
I don't get too hung up on price. I am dollar cost averaging, and I'm not really interested in much more than Apple, Google, Amazon, and Microsoft. And again, it's what I referred to earlier. I go back to 2002 and say we're in the same damn place. We're reacting to the consequences of an event. Was the dot-com bubble in the past? And I don't know of any other companies that have more data, have more talent, have more money, and are going to benefit from the change in the world we live in than those four companies. I've played around in some of the metaverse. I hold some Palantir, and the conference call that I heard of Palantir the other day, it disappointed me. So I want to stay with the companies that I think have the talent and the money and will take me into the future. And I just don't see any reason to fool around with a whole lot else other than where my passion is, and that is in biotech and genome sequencing. I look at this as an opportunity. I'm in a unique position. I think Mark is in a similar position. We aren't investing for our own needs, and so that gives us a different perspective, but yet we're competitive enough that we like to make money.
So Carrie, are there any indicators at least that you watch, like the chart or RSIs, or do you more focus on the future of the company and their vision and products?
I would say the indicator that I watch most closely right now is the price of the dollar. And that is, I want to see that the world still values the US dollar. As long as the world values the US dollar, we're going to be the preferred currency. As long as we're the preferred currency, we're going to be in a position to make the decisions in this world. I think if we have any threats to our economy, to our stock market in the future, going to come out of China and Russia. And if there becomes another world currency, then we've got problems. But right now, we have the intelligence, we have the ability to produce. I would also like to see our country basically get behind the companies of the future. I don't like that I see a Congress and an administration that fights success. I like the bill that they passed that they're going to support the production of semiconductors. I liked a speech I heard Joe say that we're bringing manufacturing back to the United States. These are all positive things. I think the only threats we have are from Russia and China at this point, and that's the only thing that can stop this market from going up.
The dollar is important. I agree with Kerry on that. The main thing I'm worried about right now is really our inflation, and although the CPI, came out and says we're at 8.5%, if you go and calculate it the way they did in the 70s and the 80s, we'd probably be at 16% inflation. And I know the CPI came down, but it came down because gasoline came down. But if you look at food and rent and all that, that stayed pretty much the same up. And I'm worried about this winter, when you take off Russian oil and gas to Europe, that's got to come from somewhere. And that's just going to cause more supply constraints. So I think we're going to have more issues with energy coming up this winter. So I think although it's good that we went down to 8.5%, it's still 8.5%. Okay. The other thing I look at is the employment rate. And I know that we came out in 580,000 jobs, but if you break that down, you see that 100,000 of that was in, hospitality, which is bars, restaurants, hotels. So they're not the highest paying jobs, even though they are jobs. So I watch that too. Over the last 12 months, the nice thing is the wages have gone up about 5.2%, but on the opposite side, inflation's gone up, 8.5%. So we're still losing out as far as people being able to keep up with inflation. The other thing I worry about is when you look at surveys and that have been out there is, 65% of Americans live paycheck to paycheck. And when you go from $40 to fill your tank to $80 to fill your tank, that makes a big difference as what they spend on or if they have any discretionary spending at all. And you can see that the Walmarts and the Targets, their inventories are up and they're trying to sell it because people aren't out shopping as much, that live paycheck to paycheck. The other thing that worries me is the yield curve. I'm looking at, I can go, get more money on a 2-year treasury than I can on a 10-year treasury right now. And that needs to either be fixed or it's going to cause us some more issues down the road. And then the last thing is really consumer sentiment. We're at the lowest we've ever had since the Michigan study came out. And until that turns around, it's going to be hard, for the economy to turn around. Even though we see some strengths coming back, we're still not out of the woods yet. And that goes back to, inflation.
Bringing that back to the stock market, I'm not worried about it. Been here, done that, seen this. We just got to work our way through it.
A lot of it has to do with where you are in your life. If you are 20 or 30 years old, you've got 40 or 50 years of investment, this shouldn't bother you at all. If you're getting ready to retire or something, you might be a little more worried about it because you're going to start taking money instead of contributing money. And so, from my point of view, I'm in a wealth preservation mode. And if I can grow it, I'll grow it. But I don't want to lose anything right now because I've spent 40 years building what I have. And I don't want to lose it because going back in history, we could have an extended time where it could take years to get back to even. It's the Dow Jones Industrial Average over, from back to the 1800s. And so if you can see, here was during the Great Depression. And when the market went down, it took 19 years to get back to where it was. So if you were 80 years old, you'd be 100 years old before the market came back. Then you go into this wasn't the Great Depression. This was the Great Depression here. It took 25 years from the Great Depression to get back to even. And then we've come into, the 60s where we had inflation and recession here. It took 16 years. So coming up into, this is the great financial crisis, it's 6 years to recover. So if you got to be cognizant of not everything just goes down by the dip and goes up. History shows we could go into a period of time that's more lengthy than, the 3 months we had during the pandemic. If you're at the wrong time of your investment life, if you're right here and you retire, it could be devastating to you. So I'd like to have your comment on what you think about that, Kerry.
My take on it is particularly you look at the 20s and 30s and your 25 year of recovery. You didn't have the innovation. You didn't have the screaming technology. Again, I would say the same thing is on this part where the 16-year recovery. The factor that is changing or that is different here is the speed at which technology is changing our world. What's Moore's law is the computing power improves, doubles every 18 months. Well, you didn't have any of that back here. And now Moore's law is antiquated. Computing power is coming even faster. I think it's kind of fun to recognize what a computer was in 2000 and what it is today. And particularly if you look at the gaming industry, what these kids can do on these computers and the speed at which they can do it, I have not experienced because I'm not a gamer. But I can apply that and say, if they can do that on a game in a controlled environment, what are they going to be able to do when they basically quantum computing comes in and you put computing on steroids? I then say you can't have a 6-year recovery. It won't take that long because the world is changing so damn fast. No, I think those days are behind us. I think the fear more is of as computing becomes more and more a part of our world and puts more and more people out of work, how are we going to employ them? Or do we find another way for people to get paid? But I can't see how you can slow this economy down or any economy down when you're going to have the advances that we're going to have in the next 10 years. And again, just take my passion. If I'm right, and if the science is there to take disease out of my body, how is that going to change our world? I just had a friend, I went to a funeral on Tuesday for a 53-year-old who died of cancer and fought it for roughly 5 years. What that cost his family and the medical system is probably in the millions. What happens when all that goes away? How does that improve our world? How do we adjust that we don't have to spend millions of dollars on disease anymore? How does it change our world when we don't have to have just look at the car industry. I sat down with a guy at this funeral. He wore shorts and a T-shirt and a hat to a Catholic funeral. And I sat down with him and I said, I admire your dress code. What do you do for a living? He says, I've worked for Ford Motor Company for 27 years and I've got all my points and I can retire today and Ford owes me $1 million. That's his pension payout. That will never happen again. He will be replaced by a robot. My worry is, where is that person of this year going to work in the future? That's the fascination. And so when I see this recovery period, all I see is it's getting shorter and shorter.
Well, I can understand that, but I guess I look at things that are, the innovation is amazing just in the last 100 years. If you've lived, you've seen all kinds of things. And like my grandfather, he remembers driving a wagon with horses, to market. And that was within the last 100 years. However, I do worry about things that we didn't have back in those days, such as this huge debt that we have and this amount of money we're printing. And if that collapses, then we will have a longer recovery time to get back on track, and we just can't keep printing money. We just can't keep going into debt at some time.
Mark, why can't we keep printing money? Why can't we?
Because it'll make your money worthless over time. Our money is being devalued right now.
We print it, and I agreed with you in 2019. But unlike you and I, our country doesn't die. So there is no end. As long as our dollar sells for $1.05 on the open market, you can keep printing money as long as you want. It's when our biggest debtors say, we don't want your dollar. So the question then becomes okay, then what do you want instead? If I'm Chile and I'm buying this tanker full of goods, what do I want to be paid with? I want to be paid with the US dollar. So I'm not worried about printing money. That's old economic.
Well, I guess I come from the old days, but
because you and I were taught you can't spend more than what you make.
Well, if you did that, and if most people do that, then they go broke, spending more than you make. What's that?
Somebody demands payment. No one's who's going to demand payment?
Well, we're in a debtor system. Even if you pay off your house, your property taxes can go up high enough that you can't afford your property anymore.
But we're talking about the United States government, the Russian government, the Chinese government. You've got to trade. What do you want in exchange for your goods? until they say, I will not accept the dollar, we can keep printing money. We increased our debt from 4 trillion to 30 trillion in 20 years, and they still are taking our dollar.
Every major empire that has collapsed because of the inflation of their dollar, like the Roman Empire, the Dutch, the British pound.
I agree. I'm reading Ray Dalio's book right now, and he is documenting it.
Yeah, and so I don't think that history is going to change, because there's some point that we go beyond where our dollar will be worthless and no one will take it, and we'll go back either to a different system. You know, you look at China and Russia and what's happening in Ukraine, and Russia's demanding payment in rubles, and then China's looking, try to make the yuan a currency of choice. So we've got a lot of competition out there, and the more dollars we have out there, it's just like anything else. If I'm a car company and I make 1 million cars, but the demand is only for 500, my cars aren't worth as much, and that's the same with the dollar, the way that I look at it. So we'll have to agree to disagree on that, but I don't think we can continue to print without screwing up our basic macroeconomic system in the world. And you can already see how just a pandemic or a war has created a bunch of chaos in our economic system. And to keep printing more money, it has to be pulled back, in my opinion.
I agreed with you. And that's why in, I guess it was November of 2019, I went to cash and said, because I heard Warren Buffett and Charlie Munger say, this just can't go on. And I said, I think they're right. And I went to cash. And then we had the coronavirus, and it was the best thing that ever happened to me, because I was able to buy in low. And then as I learned more and more about it, I don't see a crypto. Eventually, it's got to be some country's currency that becomes more valuable. China, we increased our currency through the pandemic at 40%. They increased theirs by 500%. So it isn't going to be the yuan. I don't think many people are going to stand in line to get the ruble. And I don't see the British pound or the euro. If, like you say, Russia cuts off the gas and oil to Europe this winter, that whole European situation might fall apart. Now we're looking at who's going to trade with who. And it's like Peter Zion says, we pull our ships out of the seas and it's the Wild West again for trading. And we can pretty much supply all the food, all the fuel. The only thing we need is a few semiconductors, and Apple needs to get its phones out of China somehow. I think we've got a lot more problems than printing money. I wish I understood it better, but I don't see what currency is going to replace us. I don't see us going back to a gold standard.
Well, for me, that's where it kind of all started when we went off the gold standard.
It did.
Back in 70, 71 or 72. Since that point, our dollar has been devaluing, and it takes more and more dollars to buy things because of that. There's nothing to back the dollar other than your willingness to accept it as debt. We're in a debt-based system.
Yeah.
So you can go to the bank and you can borrow. You can say, I need $1 million, and sign the paper, and then voila, $1 million appears in your account. It doesn't come from anywhere. It's there. Yeah.
And it has no value other than what it will purchase.
That's a great comment that I wanted to get into the next question. But there was a member saying that he or she purchased Roku 2-3 months ago at a high price, and it's down by 50%, and wanted to hear if you guys would sell it at a loss or invest it in, a company stable as Amazon, Google, and Apple. And as I heard from both of you, Mark was saying that, based on your age or, your period on your career, you might have a different strategy. So I would like to hear your thoughts on whether, for people who are younger, let's say have 30 years in the market, in a period like this, would you invest in a company that's a growth company that's like 80% down and think it's an opportunity, and buy that as an opportunity in these markets if he's young or she's young? Or would you still go with a company with cash flow, a solid balance sheet, and a stable growth like Amazon, Google, Apple, or NVIDIA?
I would ask your individual who bought Roku, is Roku going to change the way you live? Do they have a lot of competition? What is Roku? Roku is a streaming service. In 5 years, that'll be dead, because they'll either be eaten up by Paramount or Disney or Amazon or Google. they aren't going to change the way you live. So why would you want that company? I that just blows my mind. It's a toy. Roku is a toy. And I don't invest in toys. I invest in things that are going to change the way I live.
Well, Carrie and I will agree with this one. I'm not a fan of Roku, and I've probably done 3 videos on Roku for Best of Us, going through their financials and why I would not be a part of Roku. But to get to the member's question, when you're down 50%, it takes 100% to get back to even. So it really depends on how much money you have in there and how long you want to wait. It may never get back,
Right.
So you may want to cut your losses now. For me, the way that I built wealth over time, and I started back in mutual funds, was to dollar cost average every paycheck into a mutual fund. And then when the 401ks came, you went into ETFs and you built over time. And I didn't have to worry about it because you can see the charts we show that the markets go up over time. And if you have an expended period of time, you're going to make money with dividends. You're going to do fine. And so I would say to younger people, if your job has a 401k, max it out as much as you can, put it into an index fund and don't worry about it and go enjoy your life. If you want to learn how to invest in things, take 5-10% and watch channels like Carrie's channel and other channels and read books and go and learn about it before you just throw it in a slot machine called the online broker, which it is a slot machine if you don't know what you're doing, because you're up against sharks and institutions that are going to take your money away. So why do that? I mean, I would build my money, and that's how I tell every young person I talk to, start by, taking a certain percent, put it in your 401k. If you don't have a 401k, open up a Roth, and the Roth's the best thing you could ever have in your life as it stands today. You can take money out of your Roth, your principal, not your profits. You can start taking out at 59.5, or you don't have to take it out at all. So, I mean, if I were Drew or anyone and younger, I would be putting as much money in a Roth or my 401k as possible, and then take a little bit out and learn how the investment world works. But let the market work for you and not you work for the market. I would rather go out and have fun in my life than to worry every day about what the market does or if my stock went up or down 50%. If you're in an index fund like the SPY, or I like the ITOT that has 3,600 stocks, represent about 22% of the index. So you're well invested in that, and let the market work for you. And if one of the stocks of the 3,600 has a bad day, it doesn't affect you that much. So that's what I would do.
To both of your comments, another question that I kind of had was, so then even in a market like this, would you not then have a higher portion of cash? And as you said, if the market goes up, would you both still be comfortable having maybe a huge portion of your cash in the market and just leave it there and wait until the market goes up?
To me, it depends on your time horizon. For me, I watch charts and I watch averages, and I made it no secret that in December and early January, I went to a lot of cash. Okay, I kept some core positions and have just used that cash either doing some shorting or doing some swing trading. And when the market tells me by my indicators that we're going back into a bullish mode, I'll throw that cash back in, probably into an index fund, and let it ride like I had for the previous 15 years before, where I didn't have to worry about anything. But I don't want, Carrie and I are in disagreement, but I don't want to get into a recovery time of 10 years or 10, 15 years now for me, but I can always get back in. And I know when that's going to happen. For me, when the index hits back over the 200-day moving average, that'll give me an indication that we're going back into a bullish trend. That's what I'm going to do, because I can take that money out, invest it in other things, other assets, and then when the market comes back, I'll put it back in. I'm going to put it back on cruise control in an index fund and just do some swing trading on a small amount of money. And let the market work for me. It's worked all my life, and that's the way I'm going to go forward.
Personally, I don't keep much cash. I keep enough cash for what I'm going to need to buy or pay the bills or that sort of thing. I'm pretty much always fully invested. And again, I've taken a tremendous beating since last November, but I have the confidence that it will come back. As I say, I invest in people and I invest in companies that are going to change the way I live. And I don't want to not be invested and miss it. And then again, I have a good income right now. That makes a big difference. Some of our members of our tribe, I see they're of similar age. And if they don't have a flow of cash, a flow of money hitting their checking account every month, they need to be planning 2 years at least in advance.
What would be your plans from now on in this market? And then, from this discussion, if there was like one sentence or one phrase you want the audience to take home, what would that be regarding investment in the market in today or in general, based on your experiences?
What we're experiencing right here now today is the unintended consequences of the coronavirus. I think everything that is happening can be traced back to that. If that hadn't happened, if that coronavirus hadn't happened, I don't see any reason why the market wouldn't have just continued to go in the path it was going on. So if that is, and what created this unintended consequences, 9 trillion, actually it's now up to, I think, 12 or 13 trillion dollars of printed money that created inflation, that created a situation in interest rates now that are being adjusted. If that hadn't happened, none of this would have happened, and our economy would have continued to grow. So my takeaway is, as soon as the residual ripples go away, we'll get right back on the path we were. And I go back to, we live in a digital age. 20 years ago, we could not have done this. 10 years from now, we'll look at this and say, do you remember when we used to get on Zoom calls and they'd fade in and they'd fade out? And sometimes people would jiggle and judder. Do you remember that? That's 10 years away.
Bear markets, just like bull markets, are part of the cycle of the markets. And like I said, over the next 50 years, if you're investing that long, you'll probably go through 14 bear markets. My takeaway is, whether you're a trader or you're an investor, have a plan and stick to your plan. Okay. Don't be chasing, it's a soccer ball at a little kid's soccer game. I call it chasing the soccer ball. Every kid on the team goes to where the soccer ball is and never stays in their position,
Right.
until they learn how to do that. And I see a lot of that in the market. Whatever's in the news, people run to here or run to there, and by the time they get there, the ball's already gone. So,
Right.
A majority of people, if you really want to invest and you really want to get wealthy, and if you're young or even in your 30s or 40s, get into an index fund in your 401k, or start a Roth and start, investing weekly, monthly, whatever you can invest, and you'll be surprised how quickly that grows. And then, when you have a little extra as you get older and you have more discretionary money, learn a little bit about what Carrie's doing and what Drew and I have talked about in swing trading and how you can make money on the market itself. But let the market work for you and don't work for the market. That would be my one takeaway.
Okay, that gives you a better look at what a Discord is and what some of the benefits are. We have 3 levels. One is $4 a month. You just come in and you can chat in an open chat with people. We have a $10 subscription, and that's where I share my portfolio. I share my trades. You participate in the Friday meetings. You get the interviews. And then we have a $60 level. And what we decided to do there was basically go out and pay for some of the gurus who believe that they know and their experience is greater than anybody else's, and share their knowledge with us. And we pay that. We pay something in the neighborhood of $10,000 a year for that. And then we slice it and dice it and put our own interpretation on it, and then share it with those $60 members. So that's the 3 levels of the Discord. What we're trying to do is to build that top level so that we can bring the price down and make it more economical. What we want is a community of people who have one objective in mind, and that is to make better cumulative decisions. I like to say we're trying to turn investing into a team sport, where I put my mind out for you to interpret, and you in exchange put your mind out. We pick up doctors who know something about genome sequencing and genome editing. We pick up gearheads who understand, I don't know, is that what they call them? Who understand artificial intelligence and things like that. So that's that's what our Discord's all about. There's a link in the description. Come join us and have a good week of trading this coming week.